Hello everybody, this is Coach D with TackleTrading.com, here to talk to you about selling short call options. A short call option is a position in which a trader or investor sells to open a call option contract, thereby promising to sell the underlying asset or security at the predetermined strike price on or before the predetermined expiration date, in exchange for receiving the premium. The term going short refers to opening a position by selling a security, not buying one, and applies to any tradable instrument that a trader or investor sells to open, including call options. A trader or investor would sell short calls in anticipation of the price of the underlying asset falling in value, or staying range-bound, or simply to get paid to sell the asset at a desired price. Short calls are often sold to receive the premium and thereby get paid to sell the security. Short calls are often sold to receive the premium and thereby get paid to sell the security in advance. Short calls are often sold to receive the premium and thereby get paid to sell the security in advance. A covered call involves owning the underlying security and selling a short call or making a promise to sell that asset at the agreed upon strike price on or before the agreed upon date. Let's take a look at a risk graph for a short call option. Now, by now you're familiar with the risk graph. The bottom of the graph, the x-axis is the price of the stock. The left of the graph is the y-axis. That's the profit and loss column. And then we have that break-even line, $0. Now, imagine for a moment we sold a $50 call for $3 per share. Now, if we sell to open a $50 call, we're short the call. We receive the $3 premium. So our maximum profit is going to be $300, and we have that strike price at 50. And if we receive $3 per share, well, then our break-even point is going to be at $53 per share for the stock. So we receive that money we get paid to promise to sell the underlying asset at 50. Now, if we own the asset, that's a covered call. We own the asset, we're covered. But if we don't own the asset and we just sell a call option, that's a naked call. Now, you'll notice that this risk graph, the risk continues to increase as the price of the asset rises. And that asset can rise infinitely, technically speaking. And therefore, when we sell a call without being covered, if we sell a naked call, there is infinite upside risk in theory. Now, of course, stocks don't typically go up forever. However, if we don't have that covered, we are considered naked. Now, naked call options are pretty advanced and we don't recommend them unless you really have a ton of experience. Now, in reality, a covered call is a better, more secure kind of a basic entry level strategy that anybody can do, where you can buy the underlying asset and get paid to sell it in advance. So imagine that stock was trading at $48 a share and you got paid $3 per share to promise to sell it at 50. Well, if you own it at 48 and you promise to sell it at 50, well, you'll make $2 more, and you get paid $3 to do it, so you'd make $5 more total. Again, promising to sell that asset at a desired price on or before a predetermined date, and you can get paid now. Calls can also be used as part of other strategies like credit spreads. And now you have a pretty good idea that when you sell a call, you're making a promise to deliver the underlying asset at the predetermined price on or before the predetermined date, and you get to keep that money no matter what when you sell that call. And again, it's wise to have that position covered so that you can use it for cash flow and income. We look forward to seeing you hanging out in our clubhouse so you can learn more and more and more about call options.